Major funding for these broadcasts has been provided by grants from New York Community Bank, Capital One Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, the Witkoff Organization, Customers Bank, Ariel Property Advisors, Chase Commercial Term Lending, Chase Mortgage Lending, Perfect Building Maintenance, Genova Burns. Additional funding has been provided by AKA Hotels, Corman Communities, AmTrust Title Insurance Company, AVR Realty Company, Bank of America, Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Cohen Equities, Colliers International NYC, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Dime Community Bank, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handro Properties, Handler Real Estate Organization, HAP Investments, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Polsonelli, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Knackle Group at Cushman & Wakefield, Maring Goff Family Foundation, the Moynihan Group, and these friends.
Where are we going in 2017? Is it bright or are you going to be dull? So here today I've assembled this group of business and banking executives to provide their insight on the real estate market in 2017. My guests include Brad Dubeck, who is the market executive for New York and New Jersey for Bank of America Merrill Lynch. Chris Poulton, who is the president of Centennial Commercial Finance, a division of the Centennial Bank out of Arkansas. Winston Fisher, not Arkansas, but a partner at Fisher Brothers. And last but not least, the head of real estate financing for M&T Bank and also the divisional executive for New York, Long Island, Philadelphia, and Delaware, Peter Darcy. So I got one developer, I got three bankers. So we're going to, but you're not only a developer, you're also a banker in your other life. So we have four bankers looking at the world. How do you look at the world with regard to the opportunities with the commercial assets? We were talking about office buildings, residential, and so on.
So, well, I think inside the commercial sector that New York today has challenges, that you have for the first time in decades, an expansion of the supply, right? Whether you look at downtown, whether you look at the Hudson Yards, you have a significant amount of supply. Frankly, actually, Brooklyn has a lot of supply coming online. Long Island City has potential for new supply. I also think that there's areas that weren't considered, sort of active supply. Midtown South, that stock was not really supply, and today that is actually a competitor for what the traditional office space would going. So you have a big expansion of supply along with possible demand destruction through hoteling, through space, the ability to shrink space, 300 square feet to 150 square feet. So those are the challenges, right, that there is, and you're seeing that show up today. At the same time, there's opportunity in the sense that the commercial stock in New York is fairly old. I think the average building is 50 to 60 years old. So the people today who can embrace, can embark on a value-add strategy, I think, will see some positive results. And you're seeing that whether at our buildings, we're redoing the lobby, redoing the plaza, we're redoing the convector units, we're actually working on more branding through amenities, and you're seeing other building owners do that. So I think it's a murky outlook, but there is opportunity selectively.
But when people think of the office space, at one time in New York City, you really only thought of Manhattan. A number of years ago, I could do a show in downtown Brooklyn, and people could move to MetroTech for $20 a foot,
Right.
and after the REIT benefits, they were there for $8. You don't talk about that today. So, but now we have, as Winston brought up, we have new office property coming into Brooklyn. A lot of it, in Dumbo, in Williamsburg, and in downtown. You have certain office property in Long Island City, which we haven't really had new office property with the exception of the one building that Tishman Speyer built for the city, in essence. How do you see the office market in the suburban other boroughs?
Well, I don't think it's surprising. I mean, if you look at the demographic shift that's happened over the past 10 years, both to Long Island City and especially Brooklyn, it's no surprise that, office will be a larger component of the commercial world in both of those locations. We've also seen downtown sort of have a resurgence in its popularity for office, in part because of how close it is from Brooklyn and the ease of commuting that residents of Brooklyn enjoy working in downtown. So no surprise.
Well, I think what we've seen, which is a little interesting, is that as downtown Brooklyn and as some of these other markets have brought in some folks, there's people that were in those spaces that are now being displaced to other areas a little further out. So for instance, we've done a couple of transactions now in Gowanus where they needed more flex space. So what used to be flex space in Brooklyn, downtown Brooklyn, that's gone now as it gets priced out of Long Island City and it moves out to other parts. And so we've done 2 transactions probably in the last quarter that were folks that were moving out from there, and now they're in Gowanus. They're taking a look at some stuff that used to be warehouse or light industrial that's now going to be able to be used.
You bring up an interesting topic. Over the last, let's say, 3 or 4 years, you've seen a number of warehouse buildings being converted to, to office, as they would say, industrial office. Mm-hmm. And in reality, many of these new developers, including the Fauci building over there recently and some other buildings, the developers are charging a loss factor even greater than you would expect in New York.
We financed a couple of the early office deals in Dumbo. You mentioned the one Empire Stores would be an example that took advantage of what Brad was mentioning, this real demographic shift and the fact that there really had been nobody else doing that yet except for David Walentis, who had a lot of space and had it. He wasn't pushing rents very hard. He wasn't doing big TI packages. He had great real estate and he leased it up. And you had a couple major developments. You had the Jehovah's Witness building, which really was the first, in addition to Empire Stores, those 2 that changed the market. Both have been done very well.
But now a lot of these properties, which you wouldn't think of, which were industrial, near the Bush Terminal, near the Brooklyn Navy Yard, are being converted over there with the idea that these are all going to be occupied.
So you have these early ones that did well, kind of like with the condos, the high-end condos. You had a couple that caught very early on, and then everybody assumed that's what the market is. And then there's been a massive amount of follow-up in the pipeline development of some of that space. A lot of the volume of it is lower cost relative to the ones that I mentioned, but you also have other sites along the waterfront where there's 1 million square feet easily that's going to come onto the market over the next couple of years. That because I believe in the demographics of Brooklyn. I believe in the fact that people want to ride their bike or have the option to commute to work, and it's more fun, Brooklyn, in many ways and respects than being in Manhattan. So I believe in all of that. I think it remains to be seen how much trouble and how deep that demand is for that wider amount that's going to come on. But in general, it's pretty. Now
I'm going to give another question, which relates to an emerging trend, which probably people have spoken to you. I mean, the WeWork phenomenon, the co-working situation. All of us are aware that there was Regus, and Regus has been around, and this office concept have been around. As a lender, how do you look at the office share? And then I'm going to ask you, as an owner, how do you look at it?
I think it's fascinating, and the story hasn't been completely written when it comes to, you know, WeWork and sort of how it succeeds through a real estate cycle. I think what they're doing in many of their locations is very exciting. Having visited them, you can see the energy. What's harder to see is what happens if you end up with that space back on the market. You know, how it's absorbed back into sort of more traditional office use, and how that business model succeeds or doesn't succeed through a stress in a real estate cycle.
You're an owner. WeWork or XYZ, forget.
I think WeWork has been great for New York, in the sense that it was a pioneering company it was a disruptor, right? Regus existed, but it was not.
The Regus was an old state company.
Old state company. So
totally different.
This young dynamic company comes in, it disrupts, it creates this ability for small businesses. And I think that's a very important component as a landlord. They're going after tenants I almost couldn't service, right? I mean, we're not in any position to rent an office to somebody, and they did that. They don't service the 5, 10, 15,000 square foot tenant. That's not what their market is, or larger.
The irony is that they are going after that larger tenant today. The initial approach was the smaller company. Today they have a director of strategic development.
Right.
They and there's another company, Commons, High Commons, and I've had them on the show. They're going after, let's say,
Outsourcing of facilities.
Outsourcing of facilities. You know, TD Bank wants to open up, Ameritrade wants to be there. They're taking spaces. Samsung's going into the locations. So there's a regionalization. So
at a higher cost.
Right, but
I mean, it's
right, but
with a lot of flexibility.
Right, but with flexibility,
costs trade.
but there's been a change. So, and I think it's going to be a survival of the fittest on that situation, because
there's no barriers to entry. I think the flip side is, so as a landlord or as a lender, no matter what you look at today, WeWork is a great company, but they're far from the only company that exists today. I mean, now you are seeing everybody, and so that model becomes specialized, right? And so what you're seeing is WeWork was this general business. It took in all these people. Now you're getting this person just does fashion. This person handles tech. This person handles this, and they're good at it. I mean, the truth is, and so I think that's one of the biggest problems.
So now I'm going to
more and more people.
So I'm going to now ask you. I'm going to put your other hat on. As lenders, how do you look at a co-working? Not both a WeWork and somebody else.
Well, I think it's as was said, because it hasn't gone through a cycle. Frankly, for us, it's just hard to see how you lend on that, and so as a result, we discount the value of that. We'll treat it like it's a short-term lease, which is what it is. And so if you look through the co-working sort of piece of that and say, what do you really have? You have a whole series of tenants that are rollover tenants, and how would I treat that as a lender? If somebody brought me a building and had a lot of rollover, we'd treat it that way. You have to assume one day it's going to go somewhat dark, and then it's worth what the next person's going to rent it for. And so for us, it's been a challenge. A building that's full of that probably doesn't get financed by us today. A building that has 20% of that, maybe there's a way to make that work.
We have WeWork in a number of buildings that we have loans on. Most of them tend to have a rent lower than current market rates, which helps offset some of that concentration risk. And in general, we're not opposed to it, but it's a much more difficult underwriting than lending to a company that would have credit, for example. And they don't necessarily, they're all different, but they don't tend to have largely security or other dynamics that make them easy to finance.
I don't know how profitable that industry is yet. I mean, if you look, it's attractive from an investment perspective, but from a profitability perspective, I'm not sure that it's actually a model that can sustain itself at this level. You also have, these guys are signing short-term leases to long-term liabilities, and so that's an inherent problem.
Co-working lease is a month-to-month situation. It's the same idea. They can move in there, they can be out. Month-to-month situations are good. I still remember my friend Ophir Denny speaking at one of my events in 2008, talking about his tenants, his residential tenants. He says, before the recession, my tenants didn't live in the apartments. They only used the oven maybe once in a while, or really many people kept the oven really as a storage for sweaters and coats, sweaters and shirts, okay? He says, but once the recession hit, they started using too much hot water, they cooked too much, and the world changes. So, you know, in positive times, everything's great, but in negative times.
They've also shown that they're very good from a technology standpoint, whether it's the way they manage the facilities, the apps they've developed, how they're creating communities where they can monetize and get bulk discounts to sell. So I think that makes them different than a Regis, and I think that aspect of the company and how innovative they are make it very interesting to see. But I think there's something very serious that they're bringing, and I think it's a look into the future. Whether you like it or not, if you own that in that world or not, there's something about the shared economy that's true of all these things, and yes. Technology disintermediates everything, whether it's banking, whether it's traditional office buildings, that I think it's here to stay.
But now you bring up banking, and I'm going to bring up, from banking, I'm going to go into retail. Okay, you know, at one time, you know, there were these large edifices of Chase Manhattan Bank, okay? All of these 7,000, 10,000, 12,000. You don't have those banking floors anymore, okay? You know, even TD, who's been a major tenant in retail, is cutting down their stores, you know, the 15-year leases. It's like the limited, it's like what's happening in retail. How do you see the retail market for 2017?
Just in general?
In general.
Well, I think,
in
you
the
know,
region.
From a lender's perspective, retail is one of those areas you have to watch very carefully as you allocate capital to that segment. You know, with the closing that we've all read about of, you know, additional Sears and other large big box retailers, you know, the sort of retail that I think the industry wants to lend on is going to be and continues to be more service-based, more entertainment-based, more restaurants in more dense urban locations as opposed to suburban.
I had a very prominent retail family on, third generation of local regional people, and they were saying that, you know what, in addition to the e-commerce definitely having an effect, and you see it even now with Amazon opening up in the Time Warner Center, there are going to be some bricks and mortars tied into it. The Warby Parker is a good example. The Barnabas is another example.
It's a drop in the bucket.
I know it's a drop in the bucket.
And if you look at a lot, even though everybody knows that rents have come down, even if you take high-end and luxuries out of favor just globally compared to what it was a business that was growing so quickly, 10% a year across the world, and all of a sudden it flattened out, and everybody was taking space and occupancy for this constantly growing, more profitable, vibrant sector, and then it just stopped. And if you look at that combined with the consumer buying patterns, there's been a big decline in luxury leasing. There's a lot more vacancy, and the rents that have been signed are filled with a lot of really robust work letters and other free rents and other things that are making the face amounts look higher than they probably are today. But it has gotten better this year than it was last year. It's stabilized a little.
As a landlord, how do you look at retail?
My insights into retail are no more than I don't know anybody else who shops at retail other than, you know, we use Amazon, right? I mean, I think it's a challenge.
Amazon Prime, no question.
And last night I actually went on, I had to go, I'm buying some shorts. I went to Lululemon. The greatest thing about it, I could use Apple Pay. So I didn't have to type in all my information. I hit Apple Pay, boom, it ships it. And so the seamlessness of the online experience continues to improve, right? And so what is retail? You touched on it. It's experiential today. And so do I think retail that Sears is going to close? How many more gaps do you need? But you need a gap, right? Nike on 57th Street has a lot of value because that's a place that I can go. It's a large collection. It's an experience walking in there. Nike that's like 5 racks, who cares? Doesn't do anything for me, right? Right. So I think the retail is just going to be, I think there's a decline. Again, everything's about, there's demand destruction, right?
I had done a recent report for 1010 Wins, and I cannot believe the number of new hotels that opened up in a 6-block radius in downtown Brooklyn with about 1,100 rooms. Okay, and you know what? Fine, it's cute to go to Brooklyn, but how many people have to go to Willoughby Street in Dunphy? How do you, as a lender, look at the hospitality market?
I mean, we've never been big in hospitality. We don't do permanent loans, so we'll do some construction on hospitality, et cetera. And while we always say we don't do hospitality, I always have 1 or 2 hotels in our portfolio at any given time because.
But flagged.
No, we'll do flagged and unflagged. You know, for us, it's usually about what's unique about it that makes you want to say, sure. I think amongst all the properties that are going to be there, this one probably does okay. And, you know, the answer can be where, you know, for us, since we're not going to probably stay in it permanently, a lot of it's about, well, if this is going to be delivered at this time and then there's some other coming on, but this is going to be there first, then I can probably get out of that and move that out. Or you're just taking a look at it and saying at our basis, and in my mind, hospitality, it's not going to be any different than where we'd be on retail or where we'd be on residential, et cetera. At the right basis, I can make it work.
You know, hospitality is like the restaurant business. Each and every day, you got to get a new tenant in to operate. Okay, you know, one of the great deals that Willentis you were talking about before is when they built really the first luxury hotel in Williamsburg. It was the first.
It was early.
It was early.
We did that for them in 2009.
Right, so it was the right time to be in there. How do you at Bank of America look at the hospitality market?
Well, at B of A, it's not a big part of the portfolio. It's relatively small. We don't really play in the development space, and we don't play in the perm space. But the value-add repositioning space with sponsors who have demonstrated a great track record of being able to take poorly run property and turn it around, that's a space that selectively we do play in. And again, I think with regard to hospitality in particular, sponsorship is probably by far the most important factor to consider when you're lending.
So now we get to that topic that, you know, every newspaper, every publication is saying that the world is coming to an end slightly. Residential rental, and then we'll go to condominium.
I think residential rentals I'm very bullish on residential rental in New York. I think that New York City has a population of roughly 8.5 million. It's going to 9 million people within the next, I think it's 15, 20 years. So you have substantial population growth. You have a lot of supply coming online. There is definitely going to be, and this is, I think, very temporary, an absorption problem. That, you know, Brooklyn will open up, Long Island City's got 20,000 units, all these things, but there's nothing behind it. So the 421A, when that went away, it probably was the best thing that's ever happened to owners in the short term. There's just nothing new. I mean, on the small scale, maybe you'll name one more rental, but nothing is compared. So ultimately, that stuff will get absorbed, it'll hiccup, and as we get population
Which is
growth,
what we said before. I agree with you.
I agree. And New York is, but I think New York is, and it could help even on the commercial, even on the hotel. New York is a place that people want to be, right? This is a place where young people are moving, millennials are moving, businesses at the large scale are leaving, and so I think that is a problem. But at the medium and small scale, they are growing, and that can continue. So those things makes condos ultimately valuable, makes rental valuable, all that stuff.
How do you see it, especially since you have a national exposure in your business?
So everybody has focused on the demographics that home ownership has been down since the financial crisis. It's been harder to get a mortgage, and the millennials haven't been able to afford that first house or to get into it. So that has really fueled a shift. There's nationally been a really good demand for rental housing, and I think a lot got built, and it's probably okay, and I think it's fine. New York, I agree with everything Winston said. I would say that supply surge is coming, the big part is coming at the end of 2017. I'd say rents are softer today than people generally recognize, and that when that new supply hits, I agree, intermediate and long term, it's very good. Short term is worse than it probably feels people realize.
Fred?
And, you know, the oversupply, the temporary oversupply, the impact of that is probably not going to be as acute on lenders and on sponsors, in part because leverages have been lower over this last cycle.
I think you bring up a very important point. I think lenders have become more disciplined than they had been for many years. They've kept being disciplined, and they continue to be disciplined. I think that's really
very true.
And I think part of that is, you know, capital became more scarce bank capital just became worth more to the banks, and so the willingness to, I mean, for us, if we're going to put the capital out, it's we're going to compare that to some other opportunities we have, and so you're going to keep leverage in check, and I think others have done that as well. The other thing we're doing because of the absorption piece, which we share a view on, is we're just extending out the time that we assume the loan's going to have to stay outstanding. So where we might have said it's a 2-year deal because it's 18 months to build and 6 months to lease up, now it's a 36-month. We're going to go ahead and build it for a 36-month loan. We're going to say it takes up to 2 years to build, and it may take you a year to get it stabilized enough to get out. If it's a rental or if it's a condo, we're going to add 6 to 12 months for sell down. And maybe we're wrong and maybe it goes out faster, but that's great. The problem is when you assume it's shorter and it takes longer, that's where you have a problem. And so I think everybody's just, at least on our side, and we're seeing it on the developer side too, and on the equity sponsor side.
What about the Uber, as everybody would say, the Uber condos? I mean, the ultra expensive condos.
Well,
At
today,
one time you were in that market, but you were in there at the beginning of the market.
that's a market that, by luck or otherwise, being in early is really important. Right now, I think if you asked anyone in the know, they would say that there's a tremendous oversupply of units, above, pick a number, 7 million, 10 million, that will take years to work through.
I think the other thing on that is our view has always been that's not really a housing, that's not really a housing asset. The $10 million unit isn't really sort of, if somebody pays $10 million, they don't buy that for shelter, right? So it's sort of divorced from what's going on the real estate side.
I might disagree with you.
Yeah.
I think Winston's partner in Murray Street, Steve, when he built 150 Charles, specifically, people were living there.
I understand they're living there, but you don't put your $10 million. You have other choices.
Right,
that's an alternative. That's an alternative investment as well.
I believe it's also a locational situation.
Downtown.
It depends.
Yeah, I mean, I think so it's easy to say what's happening in the high-end condo market. Well, take Billionaires Row out, right? That's
correct.
That's not New York City.
But Tribeca is still strong. I mean,
Tribeca. So the condo market today, there's going to be, I think, more than probably any other asset class, there's going to be winners and losers, right? And there's going to be some properties that, whether is the market slow today? Yes. Is stuff selling for the right product? Yes. And the products that are good maybe take a little bit longer. Maybe they have to be built before they get the pre-sales, but they're going to sell. Right, because they're solid, good products, and there's stuff that's just bad. Not everything's worth 4,000 a square foot.
One of your number of years ago, when the world came to an end in 2008, 2009, people said I couldn't build a condo without building a model apartment. Okay, the world had changed over the years. Yeah. Maybe you're going to have to see more model apartments actually on the building as opposed to being in the sales room.
You'll see it get done, you'll see. And so I think the condo market, you're going to see a bifurcation of the winners and losers, more than even the rental market, right? I mean, for the most part, I think the lenders are in good shape, sponsors were stronger. There's always problems, but condos, there might be not, I mean, we're seeing this today, interestingly enough, as a developer and as a lender. The value of land got out of hand. It just grossly exceeded what stuff was worth. And so I can tell you there are stuff today that people said, buy it, not lend on it. Can't do it, right? Because if you have to sell at $3,200, $3,500 a square foot for what is probably a $2,200 square foot property, can't do it. It's just still great property. It's worth $2,200.
Buyers got a lot smarter too.
So, Apple, you seem to be relatively shiny. I think conservative lending, conservatism is there. I think the comment is cautious optimism. And I think that's a pretty good comment for this. I'd like to thank Brad, Chris, Winston, and Peter, and I'll see you next week.
Thanks, Mike.